So the first paper is by Amanda Heitz and Gans Narayanamurthy. It's about creditor rights and bank losses. And as researchers, we are always really interested in how legal interventions impact incentives of the people that it applies to. So within that broad theme, this paper fits really nicely in understanding how strengthening creditors' rights affects the incentives of banks when they perform their lending function. And I would just request Gans to present without much ado.
All right. So Susan and Dr. Sahu, IG, IDR, IBBI, thank you for having me here. For me, the wheel has come a full circle because my dad was a career lender. He worked, he was an IFCI, Industrial Finance Corporation of India, lifer. And our family friend was at BIFR. So I grew up to stories on, we didn't discuss cricket in our house. They discussed, BIFR, nothing will ever get resolved there, is what I heard late 80s. So for me, of course, I myself do a lot more research on the equity market side. So, treat me as a novice when it comes to, the debt markets. Okay, so I'm here more to learn than to present. I also want to say that it's, I have presented a lot more in Hong Kong, Singapore, and China than in India, which is very surprising given that my work experience was in India and I grew up here. So I welcome the opportunity, actually, and I look forward to the interactions with all of you. Clearly, this is an exciting time to be in the bankruptcy space in India, okay? Because as you can see, later on, when I talk about my research, India will be a data point. Okay, I'm going to be looking at 97 countries and so on. But these things don't really change that much over time. Okay, so being in an environment where things are changing so much day by day is truly exciting. And it is exciting for all of you as professionals because there are opportunities and so on. And as academics also, it is extremely interesting. So I feel privileged to be here. Now, as I said, things are changing over here. But, for us, you will see in our research that in this research that I'm going to present that we will treat many of the creditor rights as being constant over time and instead look at cross-country comparisons. Okay? So what is the motivation behind doing research like this? As Bhargavi mentioned before, I know that when things are changing, there is a lot of interest in implementation issues, in how things are going to get resolved. Things are changing every day, but this has less to do with the nitty-gritties of the process and more to do with, how are the stakeholders, primarily banks, but a little bit also borrowers, how are they going to react to changes in, if there are changes in the rules, if the rules are changed. So in some sense, this is answering Mr. Rajneesh Kumar's question that, yes, he looks at it as a short-term phenomenon that, yes, there will be implementation issues, and I know many professionals are interested in that. But from a policy perspective, he feels that in the long run, how does it change people's behavior in terms of attitude towards borrowing? How does it change banking behavior? So that's what we are trying to address. And as I said, it also turns out that prior research offers somewhat incongruous results. Okay, so there's a very influential paper by Houston and his co-authors, which argues that when creditor rights are strengthened, banks end up lending to a wider pool of borrowers, and so bank risk goes up. So just imagine this whole process. What is the importance of the research question is that, let's say, now clearly NPAs are a big problem in India. What will happen if we go through all this IBC in order to reduce the NPAs. And remember that banking behavior is endogenous, which means banks will also not sit idle. They will respond to these changes. You increase their rights, they might end up taking more risk. So then, if they just end up, they compensate for the, added rights they have in bankruptcy by going and making riskier lending. So then you're back where you started with the bad assets. So, that's why this first paper is very, very troubling on many dimensions. It's very influential, but it argues that if you increase creditor rights, banks will indulge in riskier lending. Now, this is a little incongruous because there is also other evidence which appears to point the opposite way. So Viral Acharya and his co-authors have this paper which argues that borrowers also react. You see, this is a multi-period game. Okay, I call it a game in the sense that everybody reacts to the rules. See, right now we were debating what are the rules, how do we reconcile them, but people's behavior changes in response to the rules. So they find that, if you have less rights in bankruptcy, borrowers will be less likely to go into bankruptcy now. So they will reduce their risk. That is Viral's paper. And I don't know, I saw Suresh this morning, Suresh Sundaresan, and he has a paper which looks at the Indian setting. And he also finds that people hedge using derivatives more, which means they are less risky once you give more rights to the creditors. So borrowers are responding by reducing risk. And there is also evidence which shows that when creditor rights are strengthened, debt becomes cheaper. It is clearly less risk, right? Risk and return are two sides of the same coin. So we found it very incongruous that somebody is saying banks' risk is going up, and when actually, debt is cheaper and and borrowers are decreasing risk. So this is where we want to see, how really are banks responding to differences in creditor rights. Okay, so that's our main research question. We focus primarily on the loan portfolio. So we look at two accounting measures. We look at loan loss reserves, which is ex-ante estimates of what your losses are going to be. And we look at ex-post losses, realized losses. And the reason we look at both of them is because neither of them is perfect. Ex-ante loan loss reserves, this morning we saw discussions about how loan loss provisioning in banks is inadequate, right? So if you just look at loan loss reserves, then you may, if those are manipulated, you will not draw the right conclusions on banking risk if you just look at them. So we look at future realized losses also. But if you just look at future realized losses, remember that we live in a dynamic world. So what was a good loan 3 years ago might be a bad loan now, right? Just the financial crisis and so on. So that's why we feel in order to give a complete picture of lending risk, we need to look at both the accounting measures. Okay, and so long as they both give reasonably similar results, we are comfortable saying risk is going up or down. Okay, that's our ex-ante setting. Now, we look at 4 creditor rights measures. Okay. Now these are things that researchers have coded. They've looked at the rules of various bankruptcy rules in various countries and they have coded them. Okay. India is one of the countries. Okay. So the 4 rules they talk about are restrictions on reorganization. For example, in the US, somebody at the drop of a hat can decide, okay, from now on, I'm not going to repay the creditor, so I'm going to go and file Chapter 11. You don't need anybody's permission for that. You can go and, this is my understanding. Okay? As opposed to, at least, in the coding, in India, you require creditors' permission before you even file for this reorganization. Okay, so that's the first variable. The second one is no automatic stay on assets. So in the US, the moment somebody files Chapter 11, there is an immediate stay on the assets. Okay? So if you have, which means that the creditor doesn't have rights to those, and you don't have that clause in many other countries, like in India, you don't have that. Okay? So there is no automatic stay on assets. Now, the third one is the secured creditor being paid first. It is amazing that there are still several countries where the secured creditors' rights don't come ahead of other stakeholders, like employees and the government and so on. So there is some variation across countries on that. And the last one is the creditors or the court have the right to remove the managers. Okay, so many of you are familiar with the Indian system. I'll tell you what the Indian coding is. So India has restrictions on reorganization, does exist in India. The secured creditor is still paid first in India. But the other two don't exist in India. Okay. Now, usually in this kind of research, what people do is if you have 4 variables, they'll just say, okay, let me make an index out of it. So they just sum it up. And we believe that is problematic for several reasons. Number one, you see both the no automatic stay on assets as well as this management removal. Both of them are contingent on there being a reorganization. So if there is no reorganization, those things don't even exist. So we feel you cannot just sum these up. The second thing is that the managers variable, if you see, managers, if the court appoints, the court can remove the manager, as opposed to the creditor removing the manager, it's not clear that this is really a creditor right, because the court doesn't always have the creditor's best interest at heart. So we feel that that is an iffy measure of creditor rights. Similarly, no automatic stay on assets. I remember that in my earlier avatar as an investment banker, one of the things we would do is that we would create a special purpose vehicle, okay, and put all the assets in that and go and borrow against that. So that takes care of this no automatic stay on assets. So when there is a contractual solution around a bankruptcy provision, then that bankruptcy provision is not necessarily particularly useful, right? So that's why we believe what we are going to do is primarily focus on 1 and 3. So we want to know if, and these are the two, India has restrictions on reorganization and has secured creditor being paid first, and there are other countries which don't have that. And we want to know how does bank behavior change with respect to either having this clause or not having this clause. Now, as I mentioned, the two variables, the two measures of risk we use are, one is ex ante, one is ex post, and these are from bank accounting. Just 2 items I'll point out here. These are slightly different from, because these are averages. India is included, but the numbers are slightly different. If you look at the loan loss reserve, on average, about 4% of the total loans is captured on a bank's balance sheet as a loan loss reserve. And on average, every year, the banks charge off about, net charge off is about 1% of the loan. So if a bank has $100 in loans, 1% is charge off and 4% is its loan loss allowance. Just keep these 2 numbers in mind, because that will help us see the economic significance of our results. So basically, here is the hypothesis, if you will, which we need to test, and that is, see if losses from the loan portfolio come. First of all, you need to have a default, so there is a probability of default, and then times the loss given default. Now, clearly, anytime you have stronger creditor rights, that is all obviously in the event of bankruptcy. So what it does is it reduces loss given default. So loss given default is going to go up. But we argue that, the 2 creditor rights measures we have will behave differently with respect to probability of default. The whole point is that if you look at secured, now when you have secured lending, then clearly banks, if you give them more creditor rights now, you make them less risky. They have an incentive to say, hey, let me go and lend to a wider pool of borrowers since I'm protected. if I, as a secured lender, I'm protected, I'm more willing to go deeper down the barrel. Okay, so where the barrel, the top layer is all the blue chip, low credit risk guys, and as you go lower down, you increase credit risk. If you offer creditor rights protection, then I'm willing to go down. So PD probability of default will go up. Now, reorg, on the other hand, it's a little bit tricky because it turns out that banks take refuge under reorganization in order to protect their assets. If you put restrictions on reorganization, which means that now it is more costly for a bank to reorganize, they will not go into default at all, right? I mean, you are deterring them from defaulting in the first place. So we argue that reorg will decrease both, and secured, we say we don't know how things will work. It could go up or it could go down. Okay, and that's what we are going to test using data from 97 countries. So here are the key results, okay, and I'll give you what the numbers mean in a second. The bottom line is, if you see negative numbers here, it means that creditor rights have decreased bank risk. Okay, now you can see that for reorg, we have about 1%. So what this tells you is that now 1% you need to compare with the 4% on average, which I mentioned a few minutes ago. So if you have restrictions on reorganization, banks' allowances need to be about 25% less. That's how we should interpret this number. And similarly, if you look at secured, which is this number, okay, that will be about half less, so 12.5% less.
Question?
Yes, of course.
Country fixed effects?
Oh, yes. You cannot put country fixed effects in these regressions because by definition, your creditor rights variables are one per country.
They don't change?
They don't change. That's the point that I first mentioned, and we make sure. Because one or two, if it changes, we drop. Because we don't have enough. We wanted to exploit it, but it turns out we don't have enough degrees of freedom for that. So that's a good question. So we will have year fixed effects and many other things, but you can't put country fixed effects because then you're throwing the baby out with the bathwater. So you can't do that. So anyway, so we do that, and then similarly for realized losses also we get a similar picture. So bottom line, okay, if there is one punchline from this result is that it does appear as if strengthening creditor rights, which has been the focus of, the initiative with the IBC and so on, it appears as if it will have, the consequence will be that bank risk will go down. So chances are that NPAs will go down. Okay, because that was what was troubling about the previous findings, which are very influential. Of course, they use slightly different data and so on, and we'll reconcile that. Anyway, so then, of course, the next thing, of course, is that we also examined risk within the loan portfolio and outside the loan portfolio. And one thing we find is that banks respond to lower credit risk by clearly they do, their loan portfolio becomes less risky, but the spread, the difference between the borrowing rate and the lending rate also goes down. So the banks are not so profitable anymore. Okay, so remember when Mr. Rajneesh Kumar says SBI, we want all this, one of the things he's doing is that the SBI shareholders may not be very happy because stronger creditor rights means that the spreads that the bank enjoys are going to go down. So profitability will go down. Because you see, remember, when there is a difference in the spread, when there is more risk, that's when SBI's expertise will come in terms of credit risk assessment. So what we find, the strange result we find is, not strange, the logical result we find is that banks also have pressure from shareholders, right? We all hold SBI shares. By the way, I was the one who did the SBI public issue in 1993. Okay, State Bank of India, a long time ago. So I have the shareholders' perspective. So, banks respond to this pressure from shareholders by increasing not lending risk, but risk in other areas, like, going to mortgage-backed securities and so on, So they do respond to this risk. But lending risk will go down. The second thing is that we also look at some time series differences, because it's well known that in the pre-financial crisis period, there was egregious lending in the US, which was primarily secured lending. So we wanted to see whether that extends across other areas. So clearly, there will be more egregious secured lending when the secured creditor is paid first. And so we do find, so this is where, see, so far I had told you that bank managers are logical. So anybody who works for a bank will feel happy. But there were certain periods, just in the pre-financial crisis period, where secured creditors were doing egregious lending. Okay, so we do find, and for that also we have a hypothesis, but the punchline is that when the secured creditor is paid first, there is that is captured by these positive numbers. In the pre-financial crisis period, there was some egregious lending worldwide happening. So banks were not, the smartest in terms of their lending behavior. And the third thing, the third contribution, the third hypothesis we have is actually a little bit more procedural, because in research, this is more of interest to researchers than policy makers. The first two have some implications for policy, and there are no measures of probability of default and loss given default readily available. So we use the accounting data to get at measures for these, and that has some issues also, but in the interest of time, I'll just go ahead. And so the bottom line, so we do a whole bunch of additional analysis. We actually, I told you before that managers can manipulate their provisions. I mean, we saw that even in the first presentation, and we actually go and test whether, the managers use their discretion in an odd way with creditor rights. And we actually find that, when creditor rights are strong, even bank managers provide less, even discretionary value, which appears logical. So the bottom line, in the interest of time, I'll just give you the summary. The summary is that stronger creditor rights lead to fewer losses, both anticipated and realized. There is decreased bank risk taking within the portfolio, but increased outside the loan portfolio, and we have some intertemporal results. And so we make 4 contributions with this research. First is to tell you, does the risk go up or down? Second is, this procedural thing that I talked about. The third is we document intertemporal differences in lending behavior, in the behavior of these 2 creditor rights. And finally, this is of interest more to people who do research in this area, this cross-country area. We strongly object to people using a blind index where you just add up 3 or 4 of these numbers and say creditor rights are strong or weak, because we find different effects for each of these individual numbers. When you have 4 measures and they all give you different results, how can you add them up and say things are strong or weak? So that's our final contribution. Okay, thank you.
What I'm going to do is quickly summarize the paper, and then I want to look at the policy implications of this paper and try to provide a framework for thinking about the impact of creditor rights on risk. And all right, so let me start by summarizing the paper very, very briefly. Right? We start with the puzzle, or the paper starts with the puzzle, and it says that other papers have found that strengthening creditor rights increases risks, but at the same time it lowers the cost of capital. And they point out that seems very odd. If you're increasing risk, then how can the cost of capital go down? And so this paper finds a sort of more conventional result, that if you strengthen creditor rights, you reduce risk and you lower the cost of capital, which sounds much more intuitive, right? Okay, that's all I'm going to say about the paper. All right, now, the question is, what are the policy implications of this finding, right? The policy implications at first glance seem blindingly obvious, right? You should strengthen creditor rights. Why? Because you will reduce the risk to the banks, and you will lower the cost of capital to firms, right? It's helping banks, it's helping borrowers. It's great. I want to step back and say, is it really so simple? All right, so let's ask a few questions here. First question is, what creditor rights are we talking about? Right? What creditor rights should be strengthened in order to sort of operationalize this insight? We need to know what creditor rights we need to change. Now, there are two that are discussed in the paper: making banks secured creditors, and restricting firms' abilities to engage in Chapter 11 type behavior, where the firms themselves declare bankruptcies and seek the protection of the court from their creditors, right? But if you think about these particular measures, the first policy, making banks secure creditors, well, it helps banks, sure, but at the expense of other creditors. So you're not sort of unambiguously improving creditor rights, you're improving bank rights, or you're improving the rights of secured creditors, right? The second policy helps the banks at the expense of the debtors. So you can see that it's not actually this quite win-win situation that at first looks. Some people are winning and some people are losing. So, all right, so now we're beginning to feel a bit uneasy. It's not quite so simple as we think. Second question, do we always want to reduce risk? I mean, after all, if we just want to reduce risk, say to banks, just forbid them from lending, right? Then there's no risk. But clearly, I mean, that's absurd, right? We don't want to do that. We want the economy to grow rapidly. And for the economy to grow rapidly, banks have to take risks, firms have to take risks. So really, we're not trying to reduce risk all the time. We're trying to achieve an optimal level of risk, right? So whatever we do with creditor rights should be geared toward achieving that ideal level of risk. So again, we need to think about things very, very carefully. All right. Third consideration, and then I'll get to the heart of the matter of how a framework that I want to propose for thinking about this, right? Now, what do we mean by risk? The paper defines risk as loss to banks, and then it points out that loss is the probability of a default times the loss given default. Now, we can ignore loss given default because that's all about dividing up the pie after the firm has failed. Right? What we're really interested in as policymakers is the probability of default, the probability the firm is going to. So when we're talking about the optimal level of risk in the economy, what we're talking about is PD. All right. So here's the framework that I want to provide, and I'm not going to take much time. I don't have any time to elaborate this framework. But I want to go back to first principles, right? What's the objective? The objective is that firms and banks should take a reasonable amount of risk, where risk is defined as the probability of default. Now, of course, you're never going to be able to define this optimal level of PD, but policymakers have an instinct for this. They have an instinct whether they want to adjust it up or whether they want to adjust it down. In the mid-2000s, the goal of all policymakers was to reduce risk down because there was excessive risk-taking in the economy, in India, everywhere on the globe, right? After the global financial crisis, the problem was the opposite. Firms became very, very cautious. They wouldn't invest, banks wouldn't lend, and you wanted to increase risk, right? Again, I'm only talking about lending risk, not trading risk. All right, so the next step is, how should we think about the interaction between creditor rights and risk? We have some notion we maybe want to increase risk in the economy or decrease risk, but how do we use creditor rights to get us there? And the point that I want to make here is it's complicated. It's not simple the way it's portrayed in the paper. All right. So I've drawn this handy-dandy graph here. This graph shows the supply of risk in the economy by banks. So if you want banks to take more risk, they're going to have to charge a higher rate of interest to compensate them for that risk, right? So that's actually a normal, if you've ever studied economics, that's a normal upward-looking supply curve, right? What about the demand for risk? Demand on the other side being the firms that are going to be borrowing, right? What does their curve look like? Well, let's think about this for a minute, right? Let's say you have a safe project. A safe project goes something like this. Say the interest rate in the economy is around 10. A safe project has a rate of return that's somewhere around 10. That way the borrower feels pretty sure that he's going to be able to repay the loan that he takes out at 10%, right? Now, let's say he has a risky project. The risky project has a chance of getting to 20% rate of return, but not such a great chance of getting to 10. In fact, the most likely rate of return for him is 5. All right? Now, what do I learn from showing you these two graphs? Well, the point that I'm trying to show is that when the interest rate in the economy is lower, people are going to take more risky projects. So, from the perspective of the firm borrowing, the curve slopes downward, right? So the bank has an upward sloping curve, that's the blue line. The firm has a downward sloping curve, that's the red line, and you get some intersection, right? The rate of interest in the economy is determined, and the rate of risk is determined in the economy. That's our natural equilibrium, right? Now, where do creditor rights come in? Creditor rights will shift that blue line. It will shift it down. Why? Because for any given level of risk in the economy, the bank can charge less interest because he has more rights. He has more ability that if things go wrong, to seize collateral and get something out of this. So, as you can see, the equilibrium in the economy will go as follows. You'll move from point IORO to point I1R1. What happens here? The rate of interest falls and the risk rises. So this paper started saying that falling interest rates and rising risk is a paradox. I say not a paradox. It comes naturally out of this graph, okay? But this is not the only thing that happens, right? It's not, when you change creditor rights, it's not just the lender behavior that borrows. It's also the borrower behavior, because the borrower will also change his behavior, and his curve will shift down as well. And the reality is that things become a little bit ambiguous. The way I've drawn this graph, unambiguously interest rate falls, but maybe the amount of risk rises or it falls. It depends on how big the shift is in the red line compared to the blue line, right? Now, so here's a case where the red line really shifts much more than the blue line, and the amount of risk in the economy falls instead of rises. Okay? All I want to say is the following, right? That exactly where you're going to wind up depends on the particular creditor right that you introduce or that you strengthen here, right? So the point is, one, creditor rights policies aim to adjust the level of risk-taking. Different rights will have different effects. Some can achieve the paradoxical of increasing risk and reducing rates, but other policies can have the opposite effect. And which one you choose depends very much on your objective regarding risk. All right? And so this is just a framework that I want to use. I can elaborate, but I have no time. Thank you.
I don't see, I mean, you said this is not what we say, but this is exactly what we say, right, in the paper. And that's the part that I'm missing, because we are talking about PD times LGD first in the one argument, and you are focusing on PD. And I thought I did say that PD, can go up if you lend to a wider pool of borrowers, and wider pool of borrowers means increasing the risk in your thing. So basically, there is no disconnect, I just think. I liked what you said and I agree with everything. And, in terms of, so that I didn't understand. But that said, I think the best point that you made in this entire thing in my mind, and I didn't make it strongly enough, is, is it optimal to increase creditor rights? So we don't say anything about, is increasing creditor rights optimal or not. But from time to time, from a policy perspective, you have certain objectives. For example, clearly right now with the IBC, the objective is to reduce the NPA in the banks and resolve this and make sure that the assets are used productively. So given, individual incentives, you try to achieve that by modifying the creditor rights in some sense. So, I don't think anybody can make the argument that, one set of creditor rights is superior to another. If it was the case, then you wouldn't have 97 countries all distributed, having all kinds of creditor rights. Clearly, one would assume that from a policy-making perspective, many of these countries are at their optimal level. And it shows that, the optimal level is not to just ramp up creditor rights everywhere. And so that is an important point. And as I said, soon you might find when you increase creditor rights, and I'll make this even stronger than what Josh said, and that is that, if you ramp up creditor rights a lot, then, the real meat that a banker brings to the table is his or her ability to assess risk. That goes away. And when that goes away, even the banking system wouldn't have profit at all. I mentioned it from a shareholder's perspective, but you can extend that argument to a social perspective and say, hey, if you just ramp up the creditor rights, then, you may not have enough incentives for entrepreneurs to take up risk. So I think that point that you made, I would like to echo. You made it much stronger than I made it, and I loved it. Okay, so that's my 2 cents.
Are you looking only at the law, or are you also considering contracts? Because a law may give you rights, but you may enter into a contract not to exercise that right. So how do you ensure that that is not happening? Is it that in those countries that kind of contract is not permitted? And if not, then how do you tackle the possibility that people may be contracting out of this kind of laws?
Okay, there is an easy answer to the question and there is a difficult answer to the question. The easy answer is, I'll attempt both. Okay, so the easy answer is that I don't do the coding. Someone else independently has done the coding, and I just piggyback on that. But that said, you do raise an important question, and actually we do try to address that very point. Because someone else coded it as a creditor right for no automatic stay. And as an investment banker, I myself have done contracts. There is always innovation happening in the contract space. And I would create a special purpose entity where I would put this, put the assets in that and borrow against that. And so I would get around this no automatic stay provision. So in fact, you are making the case that we try to make, which is that when you have coded this as a creditor right, you have to take care of innovations in the contract space. And I actually think your question is wonderful even for the second paper. Because, My question for the second one also is that, yes, I saw the JP thing and I said, a lot of the debate here is about, is this person a financial creditor or not? And I think in the long run, that definition is not that critical, just because of potential innovations in the contract space. Because here is how, as a creditor in a long-term view, what I will do is, let us say that today a bunch of court decisions, the NCLT makes a bunch of decisions which rule in favor of the consumers and say that these are all, financial creditors. Tomorrow, what will happen is that if I am a bank, I need to lend to JP Infratech. I will say I will only lend because I see my rights are being compromised because someone else is coming in. I'll say you will have to structure it in such a way that you don't offer any guaranteed returns. So, the contracting space will evolve in order to make this. I think there are two problems here. One is the short-term problem, which is there is a rule and how do we resolve it, what is happening, and there is a long-term issue. And in the long-term issue, I think always the contracting space, see, people are innovative. They'll always come up with a contract that gets around certain provisions in order to achieve an economic incentive. So in that sense, I applaud the question and, I don't know whether I answered it, but